With markets approaching levels we haven't seen since 2020, now is the time to take control of your investments and manage price risk. For over 40 years, Advanced Trading has guided farmers through unpredictable markets, offering expert insights and proven tools to tackle challenges as they arise. Given the world's economic uncertainty, adding a trusted advisor to your team will help defend what you've worked so hard to build. Advanced Trading, securing your future, one decision at a time.
Hi, welcome to the Advanced Trading summary of the USDA report for the December report. Historically, the December report isn't overly exciting, but this one gave us a little bit of extra stuff to kind of talk about. Since it just seemed like the USDA in the past has been very conservative in this report, but looking at past years, we've had, I think, a 10-cent high-low range in the last 10 years maybe on the change from the report, and today we got half that. I think roughly on corn. So good day on the future side for the farmer, I guess. But Brian, as we look at the USDA making some changes, we see good demand on corn. We've internally have said for a while that the USDA is going to have to uptick their exports. We were a little surprised in the November report that they didn't do anything. And then today they make a pretty big move on the export cut, or increase, I should say, and cut in the carryout. As we go forward, do we look for that to continue, or what's the general thoughts on that?
You had a good comment there a moment ago, Mark. USDA did surprise us in November by not increasing, so they're playing catch up a little bit now. And I think that's what caught the trade off guard today in terms of the actual carryout relative to the trade estimates. But regardless, terrific demand this fall from the export side and the ethanol side too. I guess the wild card in that, Mark, would probably be China. The USDA did reduce China imports again this month. So I don't think at the moment we can hang our hat on that possibility very strongly. However, as we all know, China is unpredictable. So that would be the one wild card, I'd say, in terms of significant quantities up from where the USDA is today. As you said, we're at 2.5 internally here on export forecast, USDA at 2.475. So it's a stout export program that's really going to kick in here. I would say the first of the year and probably continue all the way through that second quarter and into the third quarter. So I think there is room on the upside, Mark, but it probably had to be fueled by some South American crop problems now. We built in the smaller crop in Ukraine. We built in the smaller exports from Brazil. So in the absence of a problem with China or a problem with South America or Chinese demand, I think that's a good number for today.
Yeah.
Brian, real quick on that. I don't think, though, the USDA coming up to 2.475 necessarily, if China doesn't buy from the U.S., though, that's still a fair number with maybe an upward bias, though, right? It's not that we're not hanging our hat on the idea China needs to participate from the U.S. in a big way to justify that number. That number is justified for several other reasons.
Yeah, you summarized that well, Michael. I think we've seen tremendous demand, for example, from Mexico.
Right.
But not only just Mexico, some other areas have really stepped up too. Europe, as you said a moment ago, has really stepped up. So yes, I'd say that's a solid number right now today.
Yeah. So
we just don't have the competition we did a year ago from Brazil, Argentina, Ukraine, and buyers are coming to the U.S. In droves, which is a welcome sight.
So to increase that, Vinny, magnitude would probably mean China would have to be a buyer
to ramp it up to a 2.6 plus type scenario, right?
Or a problem in South America, which would really boost that fourth quarter, that June, July, August program. But given the assumption of a normal growing season in South America, yes, China would be the key step, front and center wild card.
Yep.
So with the higher exports and the reduction in the carryout, Michael's tightest carryout we've now had printed for this crop. We started, I was looking back June, I think we were like a 2.1 ish type number. And here we are now, flirting with a 1.7 even type number. As we go forward, I think you look at the flat price and you look at it and compare it to previous years, which is what a lot of people do. And you go, this doesn't just add up. They looks very similar on paper as far as carryouts, but yet prices are at lower levels than we were a year ago, for example.
Yeah. I think there's a few things with that. You know, you can look at it on paper, and you know, we just skipped, like Brian said, 200 million off the carryout estimate from 1 month to the next. 150 of it exports, 50 of it ethanol. Carry out the USDA printed today at 1738. It's not dramatically different from the crop that we just exited at the end of last August at 1760. Similar number on paper. I think the difference, couple key differences. One would be that this time last year, when we were coming into that crop, also the estimates were quite a bit bigger. We were this time last year for last marketing year thinking a 2122 in December, and then we worked our way down to that 176. We're just getting it faster this year, and a lot of that has to do with the fact that the exports were a little more back end loaded last year. This year, we're seeing a tremendous push on the export program on the front end of the crop year. We're building the program a lot earlier. I'd say that's one part of it. Another part might be that the carry out last year too. We had a better carry-in buffer for this marketing year, this 2024-25 marketing year, than we did coming into last year's. We were coming off a much tighter, not pipeline, but a much tighter scenario than we rebuilt, right? And then we worked it down with demand as the year went on. This year we started off a little more comfortable than we did last year. Then we saw the demand come in. So we're tightening up quite a bit quicker. But to your point, I mean, it is a significant drop. I think it needed to happen based on demand pacing. The question now becomes, can it continue? What are the opportunities to actually continue to ramp up demand? Like we saw last year where we, slid 300-400 million off the balance sheet from early year estimates to the final. Can that same thing happen again? Because we don't have the cushion now that we do, that we did then. And before last year, the 3 years leading into it, we're all sub 1.4 type carryouts, right? Really tight, big inverses in the summer, very much, tight supply, pipeline-ish type markets, much higher prices to your point too. So, that would be that scenario. If the demand continues, can we,
The basis and spread structure is kind of telling us we're a little tighter. But futures seem to be lagging. So we kind of talk about that three-legged stool a lot.
Right.
And it does feel like the futures need to catch up a little bit to some degree. Maybe today was the start of that. For the longest time, the funds were running a short position.
Now they're long. Record short.
And
4 months ago, 5 months ago.
Yep. And I think going forward, to what Brian mentioned, a South America story is maybe the next thing that kind of changes that dynamics. If we were to get something, any hint of a concern, doesn't have to be, just needs to be perceived, I suppose, we could see futures kind of respond and kind of get in line, if you will, with how the basis and the spread structure. Granted, to your point earlier, we don't have the massive inverses that we've had in the previous years. Yeah, granted, the July 7 corn spread's inverted, but it's not a $50, $60, $70 type inverse that we saw a couple years ago.
Yep.
So we'll see how that trade plays out, I guess. But as we go forward, I mean, it just feels like the carryout's not going to grow unless we were to see some unforeseen surprise, I think, develop, which I'm not sure what that would be today. I mean, ethanol margins maybe begin to falter, but from an export perspective, which is probably the strongest, and it's hard to argue a bullish market when you got demand driving that, I think.
If you're going to work towards demand deterioration, exports are the most elastic category. It's a lot easier to shut off or take exports down. It's easier than certainly feed and even ethanol. If we did find ourselves in a position that we needed to, constrict some demand, but I'm not sure we're there today.
Yeah. Brian, we saw on the soybean balance sheet side today, no changes. We got ConAb coming out later this week. ConAb coming out at Thursday, I think, with their monthly update on Brazil. Were we surprised that there were any changes on the soybean balance sheet? And secondly, are we looking for anything out of that report on Thursday?
No real surprises, Mark. Basically, the trade was looking at a stronger export program than a year ago relative to particularly all destinations except China. We've seen some decent export demand, but nothing compared to how strong the corn export demand is. So we weren't expecting any changes there today. China has stepped up and lifted quite a bit of beans here the last month, and they will continue to lift beans during the month of December into January. The big question, and I'll defer to you guys on this, is will China sneak in there and maybe buy a few more cargoes for early 2025, perhaps even before the new administration takes effect? Regardless, no surprises in that domestic balance sheet. Probably looking ahead, Mark, I don't see a lot of surprises in that CONAB report on Thursday. I think everyone is looking at pretty good weather conditions for Brazil as we enter pod set and pod fill for Mato Grosso and those northern areas. They've had plenty of rain. It's just hard to build a bullish case so far. I don't want to put the crop in the bin in the first 10 days of December, but for the moment, it looks like they have that full potential for that 169, 170 on the production side. Argentina, they did bump up Argentina today, USDA by 1 million tons. So when you combine those two, it would be record production, record exports for 24, 25 crop year. So that second half of the crop year for beans is going to be ultra competitive without any weather problems in Brazil.
So when we focus on weather there, what is the sweet spot? Kind of like mid-January, early January, or all of January?
I would extend it the next 45 days. Probably it's such a wide north to south variance in terms of crop maturity. Some of the beans in Mato Grosso will probably be ready to be harvested first of the year. Very small percentage, however. So really get into January, 3 weeks from now, heavy duty pod set and pod fill in the north. And then as you move north to south, maturity will gradually increase. So you can stretch it all the way out in the middle of February for Rio Grande do Sul in the far south. So yeah, the next 45, I'd say next 45 to 60 days, the sweet spot would probably be middle of January when you get into Mato Grosso, and then you get a little bit further south, nudging into maybe Goiás and some of those other states. Regardless, this crop is still, as we all know here, August weather can change a lot for bean yields, as January weather can change a lot for bean yields in Brazil.
And last I saw, NOAA was kind of forecasting a more above normal precip for that area. Is that the last you saw too?
Yeah, looking at the La Nina pattern historically, it's more dry in the far south, Rio Grande do Sul, and it's more dry in Argentina in a La Nina weather pattern. And you get into the northern areas of Brazil, it actually is wet. That's not something to keep in mind down the road when you look at the harvest activity. If it gets wet during harvest, that's a whole nother ball game. But for the time being, wet is good in terms of bean yields and something to watch though in Argentina, because like I said, dryness associated with La Nina is a big deal. We saw a couple of years ago Argentina suffer with a bad crop.
So yeah, we got some ways to go.
We've seen China buying a little bit over the past week or so. That's said to be slated for March, April shipment too. And, but there's questions on whether those sales are actually going to be held or whether they're going to be washed out and switched at some point in time. You can make a case that, maybe it's a quality hedge. Maybe it's a hedge against delayed harvest, to Brian's point. If Brazil's harvest extends out due to moisture, they're just getting some protection on the books. But, whether those sales actually get picked up and executed, we can't know that for sure today.
The last piece of the balance sheet was wheat. We saw a little bit of an uptick in exports on U.S. exports. Are you a little surprised that they raised it 25 million?
Not ultra surprised, but I would say that USDA took an aggressive stance for USDA in December. We have seen some good sales of white wheat to East Asian markets. They nudged up soft red by 5, and they nudged up hard red spring by 5. Again, these are well below year ago numbers however, for example, for soft wheat, we have no China program that we had a year ago. So I don't want to build that up too much. But we are seeing some decent demand down here when wheat got these ultra-month or multi-month lows, I should say here. Just encourage a few more end users to put their toe in the water. The big wild card, Mark, I think going forward is second half of the crop year, all the way into next May, is going to be the Black Sea. What happens? USDA reduced Russia by 1 million tons today. And they acknowledged that quota that Russia announced earlier this month from mid-February to the end of June is something that caused them to lower their export forecast 1 million tons. They did offset that, however, by Ukraine up 500,000 tons. So underscore Black Sea, it's not just Russia, but Russia is the dominant. Russia's 47 million tons, Ukraine 16.5. But regardless, if you combine those two together, it's 10 million tons below a year ago.
And seasonally, we do see our exports tend to pick up this time of year anyhow. So maybe there's some optimism in that.
We do. It's a window, a narrow window, Mark, between when the Southern Hemisphere program kicks in, which is Australia and Argentina. Australia will kick in February and March pretty aggressively. And that will close that window for us getting into April and May, and of course, moving into our summer. But there's a little window here where that program has not started yet. And maybe now with Russia pulling back a little bit, and we've got some decent sales on the books. So I think as you get into the last few days of December, particularly January, February, I think we'll see everything's relative, a modest uptick in exports for wheat. I don't want to paint the same picture as we do for corn. This is not a corn export picture, but a window there. And that may have some influence that you guys know this far better than me on the basis and spreads, but it's usually a window that closes about the 1st of March.
Michael, we shift gears a little bit to the producer side. Corn has seen its highest prices today since mid-October.
Yeah.
So versus the March futures.
Versus March.
So, I mean, I think I just looked earlier. I think maybe early October was the high. So 452 and a half quarter, I think we touched. So we got within a couple cents of that here today, roughly.
Yeah.
What's the strategy for the grower in this environment as we head into the holidays?
Yep. I think in general, there's probably a lot of producers out there that are still somewhat undersold. We got 4 days in a row of positive markets. We have some fundamental backing and support for higher prices, which is great. We're within striking distance of, I think, June highs. If we break through 452, I think you got to go back to June, see prices at those levels. So it's all encouraging, and there's more unknowns than knowns, I think, at this point as we turn the calendar into 2025. There's, a lot of guidance on policies that we're going to need to mine out. We're still waiting to see how, foreign competing exporters crops develop. There's a lot that we still have to kind of unpack and unearth here. So I think you can build a case for additional volatility and potentially additional upside. But I think if I was a grower, I'd be looking at this like, okay, we're nearing 6-month highs at this point. If you feel like you're undersold, option volatility is still fairly cheap. Big picture here, I'd be looking at putting calls on. If you already have minimum price contracts on, I would start looking at efficiencies to maybe start recapturing some of that premium, taking those up. I think min-max contracts or, buy a call, sell a call out on the curve, make a cash sale, put on, a window, or just outright own call options to help protect against spring and summer volatility. Makes sense, stay in the game, but protect the downside. Not that long ago, we saw spot futures sub $4. Grateful we're not there today, but that was very, very recently. So I think you got to be proactive and try to take advantage of this, but to maintain some degree of flexibility is kind of where my mind would be.
July 460 calls, when I looked earlier, were around 24 cents. I mean, you could argue that's 2 cents a month.
Yeah.
To get you to June, late June, roughly.
Yeah.
I mean, it gives you unlimited upside.
Right.
With a floor here at these higher values since October. And basis is also firmer than we were back at harvest. So
sure.
if you net the basis and the futures together, we're significantly higher. In some cases, probably pushing $1 higher in some markets.
Yep.
The net. So if you thought maybe we had some upside, and I would kind of lean into the supportive, friendly camp, not bullish necessarily yet, but I mean, it's hard. Probably
my mind is too.
It's hard to find a real bearish scenario, but to Brian's point earlier on the weather in South America, that's kind of hanging in the background. It's the one thing that could influence this market,
right? That
could just limit the upside opportunities. So if we were to see a problem, you'd be glad you had the call in place. And if we do see a problem, you're glad you sold the cash grain.
Yeah.
It's kind of a good position to be in today.
The demand book is awfully impressive, given that we just came off immediately post-harvest of the highest yield we've ever seen in this country's history. And we just ratcheted down the carryout from Nov to T's by 200 million.
Yeah. No, it's and I mean, for the soybeans, we've been stuck in a range for a while here. We've been just stuck in this 1015 to 975 type range. And we're on the higher end of that range, probably in the higher third of it anyhow, but this seems stuck. And maybe it's probably the South American Brazil weather just being pretty good. And so that's going to be a bit of a struggle for things going forward.
One other thing I'd add to that, Mark, and it's something that my late brother used to talk about is, remember when you're looking at marketing it's revenue too. It's gross revenue. Now, I know this isn't universal this year, but I know in a lot of places, as Michael just said, we had a record national average yield. When you're looking at it on your operation, for example, a record yield, and you multiply those bushels times that price, that's the revenue you want to get control of. That's the revenue you want to protect. That's the balance sheet you want to defend. And those are the strategies that Michael did a terrific job, and both of you did, on laying out to the viewer, is that, you know, particularly in those instances where the viewer does have that record yield and they're underpriced, as Michael said, now it's time to defend that balance sheet, protect that revenue, because we don't know what the price is going to be tomorrow, much less 3 months or 6 months from now. We've had, as both of you pointed out, though, a stout rally this last 60 days.
Yeah, we're up 25 cents in corn in short order since like Thanksgiving.
Yeah,
And not even accounting for the basis.
Right.
not accounting for the basis either, which is
We've
moved up
said it.
considerably in almost every market.
Yeah, we've said it in previous videos, but control the controllables, right? And I think that's kind of the message still here today is kind of stay in front of it.
And that's the word I would remind as a finishing thought on that is revenue, gross revenue. Yes, the price, it may go higher, it may not. We don't know. Price is unpredictable. What we do know is we can sit down today with our yield calculated, obviously harvest completed, what our gross revenue is today and how we can protect that. And the strategies that you guys just laid out are really ideal for providing flexibility, getting the floor underneath these markets, but leaving that upside open. If it wants to run, let it run.
Yep. So we got the January report is almost one of the, I guess I would almost call it the Super Bowl of reports when it comes to information. It's kind of a lot of stuff getting thrown at us. We'll get wheat acres. We'll get final crop size on corn and soybeans, yield. We'll get for D1 stocks. Obviously be watching what the South American production is as well. Is there anything as we head into that report that maybe is one of those, this is something I want to maybe pay attention to? Is there a certain storyline you think, or is it all kind of important at this point?
I guess the grain stocks report always catches my eye, Mark, for this reason. It only comes out 4 times a year. And that's where we get our corn feed residual estimate. This is a big one because this is the first estimate for this 24-25 crop year. Michael made a great point a moment ago. Typically, the domestic usage is more inelastic compared to exports. And we're going to test that this year because we've seen the meal price collapse here. And meal really looks attractive to the degree that it can substitute for corn. We'll get a result on that, what we saw September, October, November in that January report. So we'll see that first estimate of feed residual usage for the 24-25 crop year. I think final crop size will be important. But when you add it all up, there's a lot of moving pieces on that day, and we'll be right in the middle of pod set and pod fill for Brazil at that time.
Yeah, we didn't touch the production side of the ledger today, of course. Everything was demand oriented on soybeans. Nothing happened. But from Octanove, yields dropped for corn and beans.
Yeah, they did.
Now that's going to get addressed, we get the final production numbers in Jan. Based on what they did to the demand side of the corn balance sheet, we have less cushion, or the market's going to be a little less comfortable about additional attrition on that corn yield. So that's going to be something to pay attention to.
Yep. Yeah. Well, good. Any other last thoughts about the report?
No, you did a great job.
Thanks. Well, we appreciate everybody that's joined. I wish everyone a Merry Christmas and a Happy New Year. Join us again on the January 10th report when we kind of dive into what I call the Super Bowl of reports, and we'll go from there. So thanks again.